I have the pleasure to introduce Martin Pring, and most of you know him as one of the tech titans out there. He has written numerous books, especially the one I really loved, Technical Analysis Explained. I would have to say, Martin, it's one of the Bibles of technical analysis.
Yeah,
How
thanks,
are you
Evan.
doing? Are you ready to give us this presentation?
Absolutely. So the title of my talk today is Long-Term Momentum for Profitable Sector Allocations. I don't think it's a great title, but I think you'll find that the content is more appealing, especially when we get to the very end of the presentation, where we'll feature the current situation. So the traditional way to look at long-term momentum is to observe when the indicator moves to an overstretched position and wait for it to reverse. That's what these arrows show, these basic primary trend turning points, as they offer both good and they offer bad primary trend buy and sell signals. We know, for example, that up here, where the KST is high and reversing to the downside, that should be a good selling opportunity for the S&P. But what about the individual sectors? What are they doing? Well, that's the subject of what we're going to try and do today. And there are two benefits of looking at this analysis, of not just looking at where the S&P is, but where all the individual sectors are in terms of the long-term momentum. The first is to characterize the phase of the cycle by observing the position of the various sectors, to see if we can paint a picture of the maturity of the cycle. And to give you a kind of an example here, if I'm walking down a country road and I can see that the leaves are just starting to come out and the blossoms are emerging, these are signs that tell me that the current season is spring. We can do the same thing for the sector analysis at these various turning points in the market. So let's just take a look at one of my a theoretical example here of a long-term KST. I like to split the KST into 4 different quadrants, which I call seasonal momentum. So we start off with the fall when the momentum indicator is declining, but it's declining at a slow. It's rising. The momentum indicator is falling, but it's falling at the actual price is still rising, but rising at a slower and slower pace, which is what's indicated by the momentum. And that is traditionally a period when we're getting distribution, a topping out phase, and maybe even a bit of a markdown phase in the market, or the indicator or the security that we're following. Then it transitions into the winter phase, which is as bad as you can get. And because in a seasonal sense, the winter, of course, is the coldest period, and that's really when you can't really grow any crops. But as we move into spring, things improve. Well, the same thing is true in the market. When the momentum keeps coming down and then starts to bottom out and start to turn up, then that tells you you're in the spring phase, which suggests that prices are likely to move higher and you weather the worst storm. And then finally, we get into summer, which is the market phase, and it is obviously very positive indeed. So what we're going to do is to try and look at these various sectors. We observe where the S&P is. So what we're going to do is to observe where the various sectors are to see if they characterize, if they support the idea that we're in the spring or we're in the summer or in the winter phase. So let's just take a look at this chart here, which compares the S&P to a long-term KST. And what we're going to do is to take a look at this period just here, which was the low in 2003. If you look at the KST for the S&P, it was down in the winter phase and just started to turn up into spring. And we'd already experienced a 2-year drop between 2000 and October of 2002, or March of 2003, which is where this higher low is. And so we know where the S&P is. It's down here. But what were the various groups doing? So that by looking at the various groups and industry groups and sectors, we can see or get a better appreciation of what the character of the market is and whether it's consistent with a bear market low. Because if it is a bear market low, we would expect to see a lot of groups with KSTs in this position like here, so that we have a strong foundation for a rally. So here's our theoretical long-term KST here, split into the 4 quadrants. And in all these points where I'm going to be talking about, or areas, I'm going to have certain sectors which I'm going to label with a red arrow. These are early cycle leaders. And those tend to be the sectors that do well the early part of the cycle. They're defensive, they're interest sensitive, and high dividend paying, and so on and so forth. And then the other sector of the market is the late cycle leaders, the ones that do well when capacity constraints are strong, or when we have a lot of capacity constraints, commodity prices are running, and the system is relatively tight. They tend to do better at the tail end of the cycle when we're at that point. So I would be splitting them into those two areas. Some may argue that some of the ones I picked as early cycle leaders really aren't, but I'm just trying to get an overall impression of what's going on. Again, looking at this kind of seasonality that's going on. So we saw already that the S&P was in a buying mode, down below zero and starting to turn up. So let's take a look at the early cycle leaders and see what they were doing. One of the things that you want for a solid foundation for a bull market is a lot of sectors that are in this area here, in the winter sector and in the spring phase. And that's definitely what we see in this particular case. Now we put up the lagging sectors. You see that they are also in a similar situation, because it's just the end of a 2-year bear market. They also were in a very strong position. So we're in a very strong position, not only with the S&P to rally, but with all the various components here. One of the other things you can learn from looking at this stuff is that sometimes you can see something unusual happening. What's unusual happening in this particular instance in the bottom of 2003, if you recall, that was just before the housing boom of 2004, 2005, 2006. Mm-hmm. And guess who's leading the market higher here? Home builders, which will obviously benefit from a booming housing market. So home builders usually are a leading group, but in this case here, they're clearly leading the pack. So next one to look at is we're going to look at a top now. And this time we're looking at the top in 2007. And here we're going to see a completely different type of pattern taking place, because what we would expect at the bottom is what we saw in 2003, which is a lot of sectors congregated in the winter and spring position. Now, if we're looking at a top, we should see more sectors concentrated in the fall area, as the S&P is. So here's the top here, and here's the S&P rolling over to the downside. So we should expect to see a lot of indicators or sectors in that position. And so we can put our S&P in there, which we already saw from the previous chart. It's up in a distributive area. And when we look at the leading groups, or the early cycle groups, what we see is they are leading the S&P down. And it's a great reminder that the S&P is really a coincident indicator of the stock market. There are some sectors that fall before it, as we got in red here, and some sectors which fall behind it. And as you can see here, the lagging sectors, where we had this cluster of leading sectors all the way down here, starting with our home builders. And once again, don't forget, we're just about to enter the housing crisis, or the housing bust. And what's leading the market down here is basically the home builders. But I was going to point out that the leading sectors are clustered around here, and then the lagging sectors are following behind. Generally speaking, you can't say that this happens in every cycle, because obviously we've got healthcare here, which is a defensive area, in my view, lagging some of the lagging sectors. But basically the lagging sectors as a group are lagging the leading sectors because they're later to turn down. And even these over here are actually lagging, because they've got to, in order to come down, they have to finish going up. So definitely there's a consistent situation here between the coincident indicators on the S&P and the leading and the lagging groups. So now we're moving on to a slightly different period. This is 2014, and in July, in fact. And once again, we're seeing at that period there, the S&P is starting to, or the KST is starting to turn down here. So that we turn to July 2014, which is a period when the bull market was in a maturing phase. And at that time, we were several months away from the 2015-2016 mini bear market. And so we expect to see a slightly different pattern than at the bottom and at the top here. So it shouldn't be an obvious buying or selling situation, but a kind of more of a mixed situation in terms of where these sectors are, with a bias, obviously, because the prices were still going to move up for a few more months here until they moved into this mini bear market or consolidation phase. We should expect to see maybe a bias, a slight bias on the bullish side, but on balance, more mixed. So let's see what we see. Here we have bonds bottoming out down here in the spring section, and the S&P still in the summer section, but getting towards, or summer phase, but still getting towards the peaking out period. And then finally, we have industrial commodities, which are in a buy mode. So let's take a look at the individual groups. So that the industrial commodities, I should say, that are just starting to turn up, should indicate that we get several groups which are sensitive to commodity prices, like energy and so forth, and mines, looking to be in a strong period. Because one of the things we look for is to see what bonds are doing and what the early cycle stuff is doing to make sure they're consistent. So when bonds are rallying, for example, utilities should be rallying, and when bonds are falling in price, utilities should be falling, and so forth. And the same thing will be true in industrial commodity prices. If they are showing signs of weakness, then we'd expect to see commodity-related sectors doing the same thing. So let's take a look at these early cycle utilities, early cycle sectors. I said utilities because they were the electric utilities were the first ones to come up. And you can see that they were way ahead of the bond market in this case here. Bear in mind, once again, where we were in the cycle at this point here. We were sort of around here with the S&P, with the actual prices due to move up for the next 6 months or so, and then go into this sideways trading range. So bearing in mind again that the S&P is a coincident indicator, here are the leading indicators or the leading sectors, and they're all dropping down on the curve in the fall position. So then we follow up with the lagging sectors, and then we see once again that the lagging sectors are fairly consistent with what's going on with industrial commodity prices here, because most of them are in the market phase. So what I said before was, you're expecting, with the benefit of hindsight, we know that the market moved up for the next 4 to 6 months, and that was a kind of maturing phase. So here we're seeing a maturing characterization of all these groups, with the lagging groups in the markup phase and the leading groups in a kind of the distribution phase. So that was pretty consistent, and the bulk of these sectors are still in the markup phase. So that allowed the market to move higher, and that's where we saw the S&P. So now we'll take a look at coming out of this mini bear market that we talked about, the 2015-2016 bear market. And you can see where the KST fell and started to turn up, but it didn't experience one of these major buying situations that we saw in 2003 and 2009. It didn't correct as much. So let's take a look and see what the makeup is at that point there. So we're talking about October 2016, when we're coming out of this mini bear market. You see the S&P at that point was positioned in the early markup phase. And then we're looking at the industrial commodities, also started to look a little stronger here, just getting into the spring phase. And so here are the early cycle leaders. And once again, bonds and utilities are basically doing the same thing. So that's what we want to do. If we're bullish on bonds or bearish on bonds, we want to make sure that these that the utilities and some of these defensive areas are kind of agreeing on what's going on. You're never going to get total agreement, but the more that agree, more sectors that agree with what should be happening with bonds, or if we're looking at lagging sectors and commodities, the stronger the case, the greater the probability that you're going to be correct. So
All
then we
right,
look at
more questions just flying
okay.
for you. Let's see. In the chart you had up, the 2014 and 2018, he was wondering, he or she, if you see a negative divergence with the KST. Do you use those divergences frequently?
Just so we can go back. You talk about this chart here?
Yes. And I guess let's see, no, 2014 and 2018.
Yeah, there's a negative divergence. Usually use the KST from a point of view of as a long-term smooth indicator or momentum indicator that tries to tell us where we are in terms of the phase of the cycle. So obviously when it's oversold and down here and starting to turn up, that's a bullish situation. And it continues until the curve starts to turn down and cross below its moving average. So that's the main way in which it's used. Obviously, it's not perfect because over here in 1998, as you would find with a lot of these long-term smooth momentum indicators, we had an extended uptrend. And you're always going to get an unduly long lead when you get an extended uptrend because we're assuming the 4-year cycle is still operative here. And if it's not, then that's not going to work. So we'd also use the KST as well with the divergence analysis. And divergence, you want to make sure is always confirmed by a break in the price, either with a moving average crossover or with some kind of a trend line violation or with some kind of a price pattern completion. On shorter term momentum indicators or on the KST, when we're looking at the daily KST, we can actually draw, sometimes occasionally we can draw trend lines as well. So you would interpret the KST as you would with any other momentum indicator, except that the best way to use the KST is to look at this indicator in relation to how overextended it is and when it crosses its, in this case, 9-month moving average. Does that answer the question?
I think so. And then just a quickie based on what you're talking about with your seasons, they're wondering, do you think that Dow Theory is dead?
I don't pay a lot of attention to the Dow Theory anymore. I don't think it's dead. But the problem is it's kind of like Elliott wave. It's so subject to interpretation. You could always make it work afterwards. That's right. Not a problem. But it's in real time is when it counts. And I look at the Dow Theory as one other indicator. And so if I got 5 different indicators, I get to 20% weighting or something of that nature.
All right.
So I wouldn't rule it out completely, but I don't have a strong opinion of that it's as useful as it probably should be.
Got it.
Okay, now let's get on to where I was. Hold on there. There we go. Okay, I think I had the lagging up. This is October 2016 coming out of the mini bear market. And one of the points I was making was that at that point there, industrial commodities had begun a bull market. They were in a spring position. And things like materials and energy, oil and gas, metals, all things which respond to industrial commodities were all consistent with what industrial commodities were saying. So we had and we also had a very high concentration on the right-hand part of the diagram, which is obviously bullish. We don't want to have too many things on the left-hand side. Occasionally we're going to get them, but when we're on the right-hand side, that's much better. Now, sometimes what can happen, I've sort of implied that you go from the fall down into the winter, but sometimes what happens is you come from the fall and then it ticks up from above zero. And we'll see that probably in the next chart that I show you. And that means that instead of going from fall to winter to spring to summer, you get what I call an Indian summer, where you go from fall, where the curve turns up, and you have to put it over on this side, into summer. So that's what I call an Indian summer move. So here's our diagram again, and here's an example of where you had an Indian summer, where the or actually over here on 216 is an even better example, where it didn't quite come down to zero and started to move up. So it went really from a fall position just here to a summer position just here, because remember, summer is when it's rising and above zero, and that's what that is. So now we're going to take a look at earlier this year, in February of this year, and see what's happening. And as you can see from the S&P, it was in a declining phase in February of this year, above zero. And bonds were in a bullish phase because they just started to turn up into spring. So let's take a look at the industrial commodity prices were still coming down. They were in the winter position. So when we look at the early cycle leaders, what we're seeing is that there's kind of a bit of a mixed bag. Some are in the spring, summer positive area on the right-hand part of the diagram, and some are in the negative left-hand part of the diagram. But by and large, what we had, even though the S&P was in this position here of being in the fall, several leading groups were in a position of being in the spring and summer. So let's take a look and see where the lagging stuff was. And one of the things you can notice here is that lagging was very heavily concentrated in the fall section. So while some of the sectors were in a position to rally here, most of the sectors were in a position where they were needing to have some corrective activity and move down into the winter position, or alternatively cross from fall into summer. And what we actually saw with prices, so on balance, it kind of suggested that we needed some corrective activity. Well, what happened, if you can't remember, between February and June, which is going to be our next slide, was that the S&P worked its way higher, and then in May came back to where it was in February. So basically, it went sideways. So it corrected by going sideways. And that's what happened to all these groups. So I'm going to take a look and see also from the second point I'm trying to bring up. The first one is we're looking at the characterization of the market and where we might be in the overall cycle. And then the second thing, of course, is we want to make some money. So which are the most likely groups to make money between February and June? So what I've got next is a perf chart that looks at all of these sectors here from the end of February to, I think it was middle of July. And I can't see that. It's 10th of July, I guess it was. So here are all these sectors that we saw in the early part of the cycle. We're in the winter, or we're in the spring or summer quadrant on the right-hand part of the chart. Here's the S&P, and you can see most of them did, in fact, outperform. The one that didn't was this one here, which was the telecom. But all the other sectors there that we're looking at all outperform the S&P composite. So that kind of way, we wouldn't expect everything to work every time on every cycle. But in terms of consistency, the ones that we would have picked out earlier in the year were the ones that actually outperformed the S&P. We can take a look at the same data in a different format, where we take the S&P in black, and we have a horizontal line here at its performance. And you can see most of these groups, with the exception of the telecom, outperformed the S&P composite above this orange horizontal line. And then we can do the same thing at that February peak and see what's happened to some of the fall candidates. So once again, we'll highlight the S&P right here, and the red line corresponds to the performance of the S&P. So anything below it underperforms, which is what we would expect. So most of these groups, this one here, what's that? The Dow Jones Transports, this one's the materials, this one over here is metals and so forth. Most of these, 1, 2, 3, 4, 5, 6, underperformed the S&P, which is what we would have expected because they're on the left-hand part of the diagram. And then we got these two here, technology and semiconductors, which buck the trend. Again, I'm pointing out that this doesn't work 100% of the time, but it puts the odds in your favor. And now we're going to take a look at the current situation, where we can see that in July 15th, The S&P was moving sideways, hadn't started to turn, it was moving sideways. So is this another buying opportunity? Well, sometimes we have to take a look at other indicators apart from the long-term KST. And in this case here, I'm looking at the same period, a bit longer period, the Coppock indicator. And the Coppock, when it turns to the upside from below zero, is giving us our buy signal. And you can see that generally speaking, when it turns, it means what it says. You don't get too many, when it's below zero, you don't get too many jagged instances. Here's one over here, of course, a failed signal back in 2002. But fast forward to the present, it's giving us a buy signal now by ever so gently starting to turn up. So that suggests to me that we don't always take the KST as our lone indicator. That suggests to me that we need to look at some other indicators as well. And a Coppock, which is more sensitive and more subject to whipsaws, I'll grant you, is giving us a buy signal here. And then an even more reliable indicator, I think, is this PPO, using a 6-month and a 25-month and a 15-month parameter. And the vertical lines represent the buy signals when it turns up from zero. And we've had 22 positive or valid buy signals and 2 failed signals marked by the dashed red line. Look where it is right now. It's definitely reversed to the upside. This could be a whipsaw, but looking at the history of the chart, looking at the number of valid signals versus the number of failed signals, it seems to me the odds are pretty strong that we're in one of these buying situations. So let's finally take a look at the schematic diagram again with our sectors. So first thing to go up is bonds. They're positive, just a little bit above zero. And I should point out, when you could look at this position, you obviously think, or you naturally think, that bonds could continue rallying up right up to this level here and then start to turn down in a kind of natural way. But there's nothing to stop bonds from turning down from here or from turning down from there. We don't know what's going to happen, but once they start to turn to the downside, that tells us we're in a different phase of the cycle. But right now, it's not overbought, and it's in a positive position for bonds. With the S&P, what I got is a question mark as to whether or not the S&P, which is going sideways, may be branching off to move over here into the summer position. Maybe we're going to have an Indian summer with the S&P, because as we move on to this chart, I'll show you that several of the groups have already moved over on an Indian summer basis from where they were in February to where they are now. So there's industrial commodity prices. In February, they were here, and now they've progressed a little bit more. So I'm looking for industrial commodity prices to start to turn around at this point. But until we get some trend confirming signals, we have to assume that the momentum and the trend of industrial commodities is still down. So then we're going to look up at our early cycle and late cycle leaders. And here's the early cycle. And remember, there were a few of them clustered around here and slightly above zero back in February. Well, now they've all kind of transitioned and they moved to a higher level. And when we look at the lagging sectors, most of them were in the left-hand part of the chart in the fall and winter. But you can see what's happened. Industrials, for example, which was over here in February, has now had an Indian summer and transition. Same thing with semiconductors and technology. So it seems to me that we have a lot of sectors which are now positioned right where that PPO is and where the Coppock indicator was in terms of a new cycle where we can get a markup to higher levels. So I think I pretty well run out of my time here, guys. So if you have any other questions.
You wrapped it up very nice. Well, we really, really appreciate you coming on to the show today. I know all of our viewers were very excited about it, as were Mary Ellen and I, to be honest. So,
Yes.
So I'm going to wish you a good day and farewell. And again, thank you so much for being here.
Okay, thank you.
Mm-hmm.